Recently on my channel, I made a video about Bill Gates' portfolio and all of the stocks he has been selling, because he has been selling very well-known stocks like Amazon, Google, Apple, and so on. However, there was only one stock he has been buying, and the position in the stock has now grown to over $500 million, and he now owns over 10% of the entire company. In today's video, I want to dive into this stock and see what Bill Gates could be seeing here, because clearly he is quite bullish on this company. All I ask in return for all of this research is a like on the video, and with that said, let's hop right into it. The stock he has been buying is SDGR, or Schrodinger, and this is a $5.581 billion software company. What they do is they provide a physics-based software platform that enables discovery of novel molecules for drug development and applications. They operate through two main business segments, software and drug discovery. But right now, they're getting the vast majority of the revenue from their software segment, which is why I call this a software company. They're also one of those high science companies, and if you understand what they're doing and the importance of their technology, then you can start to understand if this business is one to invest in. So to best understand what this business is and the extent of what they do, we need to head over to their investor presentation. Here on page 3, they explain what their software does. So it says, "We have developed an industry-leading physics-based computational platform that enables discovery of high-quality molecules for drug development and material applications faster than traditional methods, at a lower cost, and with a higher likelihood of success." So, their software essentially increases the likelihood of biotech companies finding molecules or drugs that will become successful and approved by the FDA. A molecule needs to have all of these different properties to become accepted, and these properties do not correlate with each other, which means that adding an extension to a molecule over here could take away a trait gained over here. If simply adding more extensions to a molecule would make it work, then this last one should easily tick all of the boxes required, and it doesn't. So developing molecules is like building a puzzle, and trying to find the right pieces to make it work the way it's intended to. This process can take years and tons of trials that go back and forth through different levels of getting a new drug approved. This process also kills many bio companies before they can even get their product through the trials. Many biotech companies run solely on investor money before becoming profitable. If the process is taking too long, investors will lose interest and stop funding the company, which causes the company to go under and the drug they're developing never becomes a reality. This is where Schrodinger comes in, and here they say, "If we could calculate all the properties with perfect accuracy, designing drugs would have a higher success rate, be faster and cheaper, and would produce higher quality molecules." Essentially, Schrodinger uses AI to make the process of developing new, higher quality drugs faster, cheaper, and more efficient. And they do this by using two major approaches to help develop the drugs. The first one, again, is machine learning, or AI, and they say, "If AI can beat humans at chess and Go, recognize faces in photos, autonomously drive cars, can it be used to design drugs?" Their second approach is physics-based modeling, which requires deep understanding of the physics underlying highly complex molecular interactions. So basically, they use AI and physics-based modeling with near perfect accuracy to figure out which molecules will work and meet all of the clinical criteria. Here on page 10, we can see the benefits of this process and their software. So typically, using manual molecule design, they synthesize 5,000 molecules over 4 to 6 years, which results in the drug development candidate having some property issues, which also means that the final drug could end up not meeting all of the requirements we saw earlier on in the video. However, using Schrodinger, billions of molecules are tested, and of those billions, roughly 1,000 will be synthesized and tested over 2 to 3 years. The final drug development candidates will have an optimal property profile that meets all requirements as well. So essentially, Schrodinger knocks down the amount of initial molecules that need to be synthesized and tested from 5,000 to 1,000 by using AI to find the best ones, which seriously decreases the time needed to go through all of the trials. The final molecules they end up with also have a higher likelihood of being optimal and not having property issues, which ultimately means the chances of success is much higher. This could be game-changing technology for the drug development world, and really drugs in general. So my question as a potential investor becomes, is all of what they're saying here working? Like, is this just a nice investor presentation showing the potential, or is this all already a reality? I always say that numbers do not lie, so let's take a look at Schrodinger's numbers and see what they're telling us. Here they show us insight into their software revenue and their client growth. The first point says software annual contract value, or ACV, was $92.1 million in 2020, up 22% versus 2019. So their software revenue is in fact growing, and 22% year-over-year growth is pretty good. Next, they say they have 16 customers with over $1 million in contract value in 2020 versus only 10 in 2019. This means that more customers are taking on larger contracts with the business, which is also good to see. They also have 153 customers with over $100,000 in contract value versus 131 in 2019. Again, this just means that they're signing up more customers and/or their customers are taking on more contract value. Both are good. The last point says customer retention was 99% in 2020. This right here is amazing, and it tells me that their customers are very happy with their software and are willing to pay to continue using it. Do not discount how important this statistic is, because it means that almost every customer of theirs is sticking around. We can also see how the business has been growing over the years. Their total active contract value has increased with a 16% compounded annual growth rate since 2013, and it looks like since 2017 it's really started to pick up. It actually grew by 21% from 2019 to 2020, which means the growth of the business accelerated over the past year. Their customers with over $100,000 in contract value is also growing nicely, but it is not growing as quickly as their revenue. However, their customers with over $1 million in contract value jumped 60% in 2020 alone, which once again is telling me that more customers are taking on larger contracts. All of this right here tells me that Schrodinger's software is in fact working, and more customers are wanting to take advantage of it. Recently, Schrodinger provided financial guidance for 2021, and they are projecting their total revenue to be in the range of $124 to $142 million, which is an increase of about 15 to 31% year over year. Their software revenue is projected to increase by 10 to 19%, which is a little bit lower of a growth rate than they saw in 2020, so their growth does look like it is going to slow down in 2021. However, their drug discovery revenue is projected to be between 22 to 32 million, which is an increase of about 41 to 106% year over year. This is where the majority of the growth is projected to come from in 2021. The drug discovery side of the business, I think one day could be larger than the software side as well. So let's take a look at what Schrodinger's drug discovery looks like. What their strategy here is to use their own software technology to find new molecules and drug applications. They don't just want to sell their software to their clients, but they also want to use it themselves to develop their own drugs. Schrodinger is also collaborating with many other biotech institutions to advance their trials and advance their partners. They have about 20 programs currently going on with their partners. Most of these are still in the discovery phase, but some are advancing to phase 1 and phase 2 of clinical trials, which I think is very promising. What's also interesting is Schrodinger invests in their partners. They own 8.7% of Ajax Therapeutics, 33.3% of Bright Angel, 50% of Faxion, and so on. Most of these are private companies too, so we as public investors cannot invest in these businesses at all. It's just kind of cool because that means owning Schrodinger also means owning a portion of some private companies, and some of these portions are quite large, like the 50% stake in Faxion. Schrodinger generates revenue from these businesses as well, through research fees, clinical milestones, and potential future commercial milestones and royalties. This means that they're generating revenue from research fees immediately. Then if the partner clinical trials succeed, they will also collect payments or royalties. As I said earlier though, Schrodinger has their own programs going on right now, but all of them are still in their discovery phase. Schrodinger's programs are mostly for cancers, and it looks like they are about to enter the IND enabling stage of 3 of their programs. They have also given guidance that their first IND submission is expected in the first half of 2022, so around this time next year they should have it submitted. I am honestly hoping that they can make progress in the fight against cancer, so I will be following the development of this company quite closely. Another recent major development that I found incredibly interesting was that Schrodinger announced a multi-target discovery, development, and commercialization collaboration with Bristol Myers. Under the terms of the collaboration, Bristol will pay Schrodinger $55 million up front, and Schrodinger will also be eligible to receive up to $2.7 billion in preclinical, development, regulatory, and sales-based milestone payments. Additionally, Schrodinger is entitled to receive royalties on net sales of each product commercialized with Bristol Myers Squibb. This basically means that if Schrodinger can execute on this collaboration well, they could receive a total of up to $2.7 billion from Bristol Myers, and royalties from any drugs they develop through this collaboration. Now, for those of you who may not know, Bristol is a $138 billion drug manufacturer and has partnerships with companies like Pfizer. So the fact that Schrodinger is working with Bristol is more so a validation of Schrodinger as a business more than anything. But now let's head over to the most recent financial reporting and take a deeper look into the business's health. Here we can see the revenue growth of both the software and drug discovery segments. Both areas are seeing growth to the revenue over the long term, but the drug discovery actually saw a decline to about $15 million in 2020 from nearly $19 million in 2019. However, the overall revenue for the business still grew by 27% to $108 million for the year. What is incredible is their cost of revenues for their software segment was only $18 million, which gives Schrodinger a gross margin of 81% on this segment of the business. The cost of revenue also only increased by $4.4 million year over year, but the revenue generated increased by nearly $26 million. This simply means that Schrodinger's software business is incredibly profitable. However, their drug discovery business is quite unprofitable. In 2020, the costs increased by $26 million, which means they're losing about $11 million on this segment of the business annually. This is not unexpected though, and as I mentioned earlier, this is one reason why being able to speed up the process of drug development is incredibly important for biotech companies and their investors. Despite this, the company's gross profit for 2020 was $63 million, which gives them a gross margin of about 58%, which still isn't that bad. If we also take a look at their operating expenses, we can see the business spent nearly $65 million on research and development, which is more than they generated in gross profits. The research and development expense is also up about $25 million from the prior year, so they're increasing their investments back into the business. Sales and marketing expenses actually dropped year over year, but general and administration costs increased as well. I imagine this is because the business is continuing to expand, hire more people, and invest back into the foundation of the company. The total loss from the operations was nearly $61 million, so they're not profitable by any means. Next, let's take a quick look at the balance sheet. Here we can see that they have a total cash position of $202 million and marketable securities of $440 million. This means that they have a total of about $642 million in cash and cash equivalents. Their total current assets are also sitting at near $683 million, and what I like is that nearly all of this is sitting in some form of cash. They have total assets of $746 million, and once again, the majority of the business's assets are sitting in cash. Now, we can also see that their total current liabilities is sitting at $73.2 million, and their total liabilities are $122 million. What this means is that Schrodinger's balance sheet is incredibly strong. They could pay off every liability the company currently has and still have about $500 million to spare. On March 4th, they also issued a shelf prospectus, which gives the company the ability to raise another $164 million if they should need it. This is not dilution, but it gives the company the option to dilute on a moment's notice. Next, we can see that analysts are projecting Schrodinger to produce about $583 million in revenue by 2025 and $247.9 million in earnings. This is an increase of nearly 400% in revenue over the next 5 years, and it looks like analysts are expecting the revenue to start increasing more dramatically in 2022. However, this is also where the valuation starts to deter me. Schrodinger is currently a $5.5 billion company, which means that it's trading at near a 10 times price to sales on their 2025 projected revenue, and about 22 times their 2025 projected earnings. This is a very hefty premium to pay for this business, and it tells me that the stock is most likely going to be incredibly volatile over the coming years. However, I do have to say that I do see the potential in this business's technology and how AI could be used to help discover and develop new drugs. The fact that their software is bringing in so many new clients and retaining nearly all of them also speaks volumes. I have no doubt that Schrodinger as a business will continue succeeding into the future, but I do have to say that I think the valuation is making this much more of a speculative investment than anything. If the valuation was half of what it is today, then I would be much more comfortable investing in this company. It also seems like this is a more speculative investment in Bill Gates' portfolio, and it makes up less than 5% of his total portfolio holdings. The Intelligent Investor says that you should keep your speculative investments below 10% of your total portfolio value, and it seems like Bill Gates is doing just that. I really do love this company and what they're doing though, and I could see them becoming a massive business, and maybe even a game-changing one in the biotech space. If they truly can progress their cancer research and execute on their Bristol-Myers collaboration, then this could be a beast of a company in the future. The only problem is I have no idea how much of that future is already priced in. And I also have to admit that their cancer research is a little bit out of my circle of competence. Like, I have no idea if that's going to work and what's going on there. However, I do understand their software and how important it could be for the drug development space. But I do think a lot of their software potential is already priced into the stock. Honestly, this really sucks because this is a business I would love to add to my portfolio. The valuation has not scared off Bill Gates though, and as I said, in Q4 2020, he has been buying more of this stock. Cathie Wood also owns nearly $200 million worth of shares in this business, so clearly she sees something here as well. But let me know what you all think and what your thoughts are in the comments below. Do you guys think that the stock is currently overvalued, or do you think that it's presenting a good investment for the long term? This was pretty much everything I could find on the business, and I tried to explain it the best I possibly could in this video. So are you guys buying this stock? Do you think it's a good long-term play? Is it a speculative investment? Let me know your thoughts in the comment section below. Also, if you did enjoy this video or you found it informative or insightful in some way, then please remember to leave a like on it because it really helps out my channel. But with all that being said, thank you all so much for stopping by my channel and checking out my video. If you enjoyed the video and you want to stick around and see more content like this, then please consider subscribing as well. But that's going to wrap everything up, so again, thank you all so much, and I hope to see you all again in my next one.